please subscribe and don't forget to press the bell icon to get notified whenever we upload a new video.
By half and cutting its Boston corporate staff by 25%, Michael.
Yeah, you know, and I think investors were braced for some radical moves. Certainly, I think braced for a dividend cut. But GE kind of reduced that baseline of earnings and cash flow for next year, upon which they hope to build to a level that was low enough that just was not able to make the stock look cheap right here. And I do think that today was almost a maybe part of the capitulation process by investors. Tremendously heavy volume. A lot of people saying, look, we don't really see the light at the end of the tunnel here. Maybe that is the sign that slowly it can turn.
And Rob, those shares are down about 40% now year to date. And I'm sure the company was hoping maybe that bottom was already in, and maybe with this news they'd start to stage a rebound, and that's what happened initially on the announcement, but not here at the close.
Yeah, I mean, there were some shocking bits to this. I mean, if you look at it, they actually have sacked their board, half of their board. They have 18 people on the board. They're going to 12. They're adding 3. So there you go. 9 are gone. I mean, that just tells you that how there was something revealing to Flannery's gone in there and what, 6 months into it. He has completely turned an about face on the company's strategy, on its outlook, on its entire face to the world. And I think a lot of people look at this and go, all right, this is not just something where it's going to take 3 months, 6 months. This is a full restructuring. And you got to have, do you want your money to be sitting in that for a year, 2 years before you finally see something at the end of the tunnel? I'm not so sure you do.
Kim, do you guys?
Well, it's tricky, but they do have some really great assets. GE Jet Engines is one of those big assets, and it's why we've been in this stock for a very, very long time. And even though power isn't exactly burning up the place, pun intended, it's still a powerful component for the company. So there are parts of it, but it is going to be a really tough slog, I think, for owners from here on out until the vision really starts to be executed.
So you're not owners of it yet?
No, we currently own a position in it, and we've held it for a very long time.
Long enough that you're burned?
Long enough that we're burned.
Yeah, okay. You're hanging on to it still.
Everybody who's holding this basically is burned. I mean, it's like a 5-year, more than a 5-year low at this point.
Yeah.
I mean, if you bought it in the crisis, you're doing okay.
Right. It's very, very lows. Let's talk about a merger Monday. Hasbro making an offer for rival toy maker Mattel today. And look at Mattel shares up 20%. Even Hasbro is up nearly 6%, even though the terms of the potential deal aren't yet known. Mattel still had its best day in 30 years on that news. On the flip side, Qualcomm's board of directors unanimously rejected the bid from Broadcom. Qualcomm CEO Paul Jacobs noted the proposal, quote, significantly undervalues Qualcomm relative to the company's leadership position in mobile technology and our future growth prospects. Still, Qualcomm shares were up 3%, Broadcom roughly unchanged. And then the New York Post reporting that Charter Communications CEO Tom Rutledge is looking for more acquisitions, although major shareholder John Malone is reportedly more interested in selling Charter. That stock, Mike, up about 1.5% today.
Yeah, it seems like it's sort of the season or that point in the cycle where it's decide who your partner is going to be one way or the other, or where you're going to fit into the future of your industry. So all that stuff, I think, plays into all these situations. The Qualcomm deal, I think, is not very surprising. Not only do they think that stock does not Broadcom does not have a ton of room to maneuver here. Doesn't have the balance sheet, may not have regulatory clearance. So a lot of this stuff, I think, is easy for them. Mattel, Hasbro, fascinating. I think you're seeing a lot of these sort of secularly challenged companies decide, let's get together with our arch rivals and go after the bigger enemy.
And Rob, in the past, I mean, it's funny to think that there might be antitrust concerns with toy companies, but at the same time, you don't want there to be a monopoly on toys driving up the prices. Is there any kind of concern about that today that would keep these companies from uniting forces?
Well, this is the fascinating overhang of antitrust policy that I think is actually going to be tested. Now that Donald Trump has his person in at the Department of Justice overseeing antitrust, the first real test case is going to be actually this AT&T Time Warner thing, and you've already seen that they're taking a pretty harsh line about vertical integration. In fact, so much so that AT&T says it would upturn 40 years of antitrust policy, right? So a lot that, but then again, look, 50% of the doll market apparently would be held by Hasbro, Mattel. But you have you have to look at the market, right? Like, so what are the bigger factors that are impacting these guys? Is it going to be the fact that Toys R Us has gone bankrupt because online is now the thing, and so it's really the marketplace is really shifting. I think every single one of these deals you really do have to look at on their own. It's not like there's oh my God, stocks are up merger Monday. I think we're going to be every single one you have to look through the prism of a really shifting antitrust environment.
Kim, I want to get your thoughts, but first we have some more developments on VC investor Steve Jurvetson, who today is stepping down from his firm DFJ after allegations of sexual harassment. Josh joins us this hour with some more details. Josh?
Yeah, Kelly, Steve Jurvetson did just take to Twitter to confirm that he would be leaving DFJ, as you noted, in the wake of that investigation into sexual harassment at the firm. Remember, Kelly, Jurvetson also does sit on the boards of both SpaceX and Tesla, and those companies telling CNBC in a statement just now, Steve Jurvetson is on a leave of absence from the SpaceX and Tesla boards pending resolution of these allegations. Kelly, Steve Jurvetson is friends with Elon Musk, a big believer in Elon Musk. I've interviewed Jurvetson a few times for CNBC. He is a great believer in Elon Musk and his investments. They share a number of passions, including all things space-related. When you go to Jurvetson's office, for example, there on Sand Hill Road, it's a virtual private space museum. But again, Kelly, SpaceX and Tesla now telling CNBC that Jurvetson will be on a leave of absence from those boards. Kelly, back to you.
Josh, thank you. Kim, do you guys have a lot of overlapping investments? I know you're a big tech investor here. Would there be reason now to kind of look at those, look at his involvement and his, maybe lack of thereof going forward?
Are we talking about the Qualcomm or the venture capital guy?
Yeah, in the case of Steve Jurvetson, I'm just wondering if he's now having to take a step back, given his involvement in a lot of those investments. Sure. Is that a red flag for you?
I think these are venture capital more so probably than equity or bond portfolio managers. It's a very personal view about a company, and they also have a lot of input into these companies. So when people leave venture capital, it is a red flag. And if you're an owner, I think you'd have to take a good hard look at, continuing on in their funds or not.
Yeah, I also did want to circle back to you just on that last point we were making of one of the deals being this tie-up between Hasbro and Mattel, Kim. That make you an owner of a space where, as I understand it, STEM, a lot of these science and tech-focused toys for young women have been making a lot of inroads, and certainly for boys as well, against the toys that they currently offer.
Well, I think there's a very low barrier to entry in the toy business. It's probably more a matter of distribution. And with, online becoming such a large part of buying products, you could probably talk your way into getting Amazon to take a look at your toy. So I think this is great that they are banding together and to try to do, be a bit more powerful in the marketplace. But it may be too late for both of these companies.
Would you own them, either one?
No, not right now.
Okay. Let's talk about regional banks getting a boost after Senate lawmakers reached a deal to ease some post-crisis bank rules. The deal would exempt banks with up to $250 billion in assets from increased oversight from the Fed. It would also exempt banks under $100 billion in assets from annual stress tests. A big day for regional banks, Michael. Rallies 1% to 2% more in some cases.
Yeah, this was a hoped-for development. It was kind of understood that they were going to try to draw this threshold. Definitely good time for a bounce. You also had the 10-year yield firm up a little bit, but this has been a weak sector. I think it's been hard to escape notice that basically the last week or so the banks have been sagging. So this was actually probably a welcome relief in that area.
And Rob, there have been reports about some of these banks trying to shed their bank holding companies to avoid Fed regulation and just try to eliminate at least one layer of the many regulators they do have to report to. What's your takeaway?
Well, my takeaway is that you're going to see M&A and consolidation now in that $50 to $250 billion range. I mean, there's still like a third of a target's cost cuts that can be costs that you can rip out with these deals. I mean, if you were worried about chirping yourself, let's say you're 20 billion merging with a 50 billion or whatever it might be, the threshold basically kept you because you had to make the calculus. Am I going to pay more in sort of increased complexity costs and capital requirements, blah, 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 all the stuff that comes with being, having Fed oversight. Now I guess you could make the case for doing it. So I would have thought one of the reasons that people are excited, or investors are excited, is they'll see some M&A in that space.
Yeah, that makes a lot of sense. Certainly keep our eyes peeled for that. And finally, as the Senate Finance Committee today begin to mark up its tax reform bill, President Trump is calling for some tweaks to the GOP tax plan. He did tweet, how about ending the unfair and highly unpopular individual mandate and Obamacare and reducing taxes even further. He said cut the top rate to 35% with all of the rest going to middle income tax cuts. Mike, we know he's wanted this. Does he get the move on removing the individual mandate? The Senate's plan does have the top rate at 35%, as I understand it. Where are we?
In terms of the individual mandate, I mean, this has been something that was thrown out there to potentially, I don't know if it's going to ease the way or if it just adds complexity to the whole process. I really don't know. What does seem clear, though, is the committees in the Senate and the House are writing this bill. And they're not really in the mode right now of taking direct input on details from the White House even, I think because they want to just get things through committee and then hash it out in reconciliation.
Kim, how closely are you following? I mean, this would be a big deal, as we know, for maybe corporate earnings next year.
Right.
But as we try to figure out whether this thing even happens and how much they're going to lower the rate if they do, what's most important to you as an investor?
Well, I'm still going to look at the corporate rate, and I think that really matters, and it more matters to the non-public companies. And I think that the president knows this, and has been trying his best to get something to happen and get tax cuts to happen for corporations. Again, as an equity analyst specializing in traded companies, I don't know that it's going to have all that much effect on most of my companies, but it will have an effect on smaller non-public companies, and that extra money floating around the economy should do better should drive the economy somewhat.
Yeah, that's the hope. Rob, we're out of time, but in a word, we'll give you the last word. Does this bill get done, yes or no?
I'd say it's 60% chance it gets done, so that's better than 50, which is what I said last time.
And better than 40%. It's always kind of the go-to hedge. Rob, thank you very much. Rob Cox, Kim Forrest as well.
Thank you.
Thank you both for joining us here. Shares of General Electric sank today and closed down more than 7%. That means they're now down more than 40% this year. CEO John Flannery laid out plans at the company Investor Day to turn things around. Today, he announced GE will slash the dividend in half and focus on power, aviation, and healthcare equipment units. It's also trimming the board and revising the compensation program. Investors did not seem impressed today. Is the bleeding near an end? Let's ask Graham Copley from SSR and Scott Davis, who's here at Post 9 from Melius Research. Guys, thanks for being here. Graham, why do you think the shares reacted so poorly today?
I think it's a simple answer, Kelly. He slashed the dividend, which everyone was expecting. He gave much more conservative guidance for 18, but that was all they did. They didn't really explain why they want to keep the businesses together, that they're keeping together. They talked about the company being too complex, but they really haven't set out a plan to make it any less complex. And so I think there's a lot of doubt cast as to what this company can really earn, not just in 18, but 19 as well. And I think that's what has the investor base somewhat scared, is that this is a company that can make $1 a year for the next 3 years. Why do I want it?
And Scott, the other read, I guess, in what wasn't said or what was implied, I get, is that there's been this accumulation of, kind of either living beyond the company's means or not reckoning with exactly how profitable the business is, what the cash flow levels really are. So where are they in that process of trying to kind of come to terms with that?
Well, I think that's one of the disappointments from today, is that Flannery had an opportunity to really set the stage for, hey, these are the sins of the past, and here's how we move forward. And he had an opportunity to really throw his prior, Jeff Immelt under the bus and the board. How does a company drop earnings 50% literally overnight in a macro expansion? It's just unbelievable, and I don't think we've heard the end of this yet.
Do you think they've made some wrong decisions here, then?
Yeah, I mean, I think they've made terrible decisions. I mean, they've been raising.
I mean, today.
Oh, today. Well, the reality is that Flannery needed to do more. The stock price tells you everything you need to know at this point. I mean, cutting the dividend was just part of the show. The bigger show is that these businesses shouldn't be together. I mean, he talked, as Graham said, Flannery talked about it being too complex of a company and complexity being one of the main problems, yet he didn't do anything to address that. So personally, I think that's why the stock was down.
Graham, if it's the case that healthcare, aviation, and power don't really have any obvious synergies, then why leave them together? Or does this, especially with the share price reaction, start to point towards a breakup?
Well, I hope that it does, Kelly, but I think we talked back in June about the problem of hiring an insider to do this job. And I think today we saw an insider's presentation of how to remake GE, which is basically do a little bit at the edges but keep the core together. The only way he's going to make the company less complex is to break it into much more substantial pieces. And holding on to the energy business is just not, that makes no sense at all.
If there becomes a core sort of stump of GE, which one is that? Is it aviation? Is it healthcare?
I think you sell the pieces you can sell, frankly, rather than try and create something, on paper to begin with. If there's a good price for the healthcare business, sell it. If aviation has a good public market value, spin it out and see what you're left with. But power is the real problem company. That's the one that needs the work.
Yeah, Scott, real quickly, John Flannery is going to be back on the network tomorrow morning in an interview. And last time, the shares reacted quite well. They felt like he was candid. He kind of came clean about the problems. What are you expecting from him tomorrow?
Well, last time he did a fantastic job. Today he fell flat, unfortunately, and we don't know why. I think he needed to announce something bigger. He's explained why he's not spinning out healthcare, why he's not doing something in the power business. He needs to cut costs to a much greater extent than what he announced today, and he needs to be accountable for where the share price is trading now. I mean, he's been 100 days on the job, and it's been straight down for 100 days.
All right, it's a tall order. Thank you both, Scott Davis and Graham Copley, joining us to talk about shares of General Electric. Now, with that 50% dividend cut at GE, a lot of people wondering what other dividends might be at risk here. And there are alternative stocks where investors should be looking for yield to put money to put their yield. Anyway, Kevin O'Leary joins us. He's chairman of O-Shares ETFs and co-host of Shark Tank. And Sarah Hunt is here. She's a portfolio manager at Alpine Funds. Sarah, the core question is, where should you go for yield now? And what should you avoid that might also be at risk here?
Well, I think that you had a big scare with energy prices being a lot lower a few months ago and a year ago, and then all of a sudden those dividends seem a lot less at risk now than they did then, and I think a lot of the big majors look pretty good. We still own BP, we still like the dividend there. I think there are some sectors that obviously look like they're at risk, like retail. There are some sectors like telecom that people are sort of worried about the cash flows, because you have a combination of you need the cash flows both so that you can invest in your business and pay a dividend if you're a dividend payer. And when those cash flows start to overwhelm or the dividend becomes too big, that's when companies start to get into trouble. So areas where it looks like revenue could be falling, those are places where you need to be a little bit wary and where the cash isn't coming in the way it used to.
Kevin, what about you?
Well, I like a sort of a back-of-hand rule when I look at dividends. The S&P SEC yield is just around 2%. So if you ever see a company that's 3 times that amount, let's say 6%, you know bad things are about to happen. Basically, if a stock is trading at $10 and has a 3% dividend and it gets cut to 5, sort of the GE story, for a while the dividend looks like it's 6%. It's just a warning signal. I think to de-risk the portfolio these days, I like the old traditional names that have tremendous cash flow, less leverage, and high return on assets. A J&J, an Exxon, a P&G. Those are household names, boring as hell, but really safe for the next year, given that I think volatility is going to return. You got a little taste of it today when the consumer sector really performed, and it's a very boring sector.
I guess, Sarah, the question is, what should investors do instead of looking to stocks for pure yield? I guess what my question is, Kevin mentioned some boring stocks. What's even more boring is investment-grade corporate bonds at 3.5%. I mean, if that's really what your game is to just get the yield, maybe stocks that look like they have a juicy yield are a warning in themselves.
Well, I think the tricky thing is that fixed income has come down. I mean, the interest rates on fixed income has come down so far. To your point, corporate yields at 3%, even high yield, which has started to come in and yields have started to go up a little bit. You've compressed those spreads so tightly that people are looking for stocks, and they're also hoping for a little capital appreciation as well as that, which they're not looking for in the bonds. And I think that when you've got bond yields down to the point point where you're matching some stock yields or lower than stock yields, people are going to keep looking at stock yields. And I think, again, you just have to be careful. What is the cash flow coming in? What do they need for the dividend, and what do they need for their business? And if they can manage those things, then they can handle those. And to some of them, I mean, one of the reasons consumer goods were doing so well for a while was because they were stable dividend payers and people were willing to pay higher multiples for them. Now the multiples have come in, but they're still paying those dividends.
Kevin, final question. We look at some of the highest earners in the S&P there, names like Macy's, like AT&T. Does the high dividend yield itself tell you to stay away, or do you have to look more closely?
No, I look at the return on assets, and I look at free cash flow, and I look at how much debt is on the balance sheet. All of those matter as well. If you have too much debt and you're putting too much cash to service it, and rates do go up because we haven't really figured out if the Fed's going to raise in December or not, those are all problems for companies like that. Leverage now, as rates start to increase, is going to be a problem for lots of balance sheets, particularly in retail. You know, right now, fixed income is not a really interesting place yet. But if the Fed raises rates and we continue to see those rates increase on basically junk debt, I mean, JNK has had a pretty rough ride because people are getting worried that those companies can't perform well in a rising rate environment. But at some point, at a 5% and 6% and 7% yield, I might get interested again in credit.
All right. That's the benchmark. Thank you both. Kevin O'Leary, Sarah Hunt, joining us talking dividends there.